G'day guys, it's Ben and Adzi here today on the Pumped On Property Show podcast. Great to have you with us. Now this is going to be for all the data geeks out there, a bit of one of those today. We're just talking about it off camera. How do we make this information more fun or keep it more conversational? And we realised there's like no real way to do it without, coming across a bit data and a bit geeky today. But the question that we're trying to answer today is really this question that I've been asking myself for a while now, and that is it the right time to actually think about buying property?
Yeah, and I guess with a lot of things changing in the marketplace recently, well, not so much the marketplace, but the political landscape, Liberals got back in, woohoo.
Woohoo.
We think at this stage, obviously we've done a lot of research and we keep a track on these sort of things, but it's our research is researching what other people have researched and what their models are saying, and it all points in a very positive direction from what we've been reading.
Yeah, so Ben and Adzi certainly don't have a crystal ball. These are using other people's crystal balls today, as always. Take everything in this one with a grain of salt, but we're going to have a bit of fun with it, or as much as we can. And really, the concept now is that now that we actually know that Liberals in, things are probably going to get more positive a lot quicker than they would have from a property perspective than if Labor had have come in and we would have had another 2 or 3 hard years. Now, again, we don't know what's going to happen globally or locally that could disrupt the boat, but I already feel more confident. I'm not a political guy. I've voted Labor and Liberal before. I just swing based on who can help me at that stage of my life. But I did get stoked even seeing Bill Shorten's acceptance speech, because I was kind of like, oh, he's got a soul. He's a human and he's stoked.
Bill Shorten's acceptance speech.
Oh, fuck. SQM's acceptance speech.
You got told so many times that Labor was getting in that had just been programmed into your brain.
I built my full plan over the next 3 years based on Labor getting in. I thought it was that's not getting edited out. Nice, guys. So why don't we kick it off? Maybe you can walk us through, Adzi, some information that you actually sent to me, which was a sick report from SQM Research.
Yeah, they basically just did some modelling on where they would expect the market to go, and I guess the overall Australian market and property space. So it's, I don't know, you can take it for a grain of the salt. It's a very complicated thing to model. So good on them for giving it a good try, and I'm sure that it would be much better than what majority of people out there could do. So we were pretty excited to see that someone was putting the time in and actually going through. They've broken it down for all the major cities in Australia and kind of put out what we're expecting for potential price growth in those capital cities, but on the flip side, what may have happened with rental incomes if Labor was to get in and to put forward those negative gearing policy.
So because Labor's gone, maybe we can just talk about Liberal today and SQM's forecast between 2020 and 2022, breaking it into capital cities based on capital growth and then maybe cash flow.
Perfect. So the way they've done it is that it wasn't just straightforward as Labor or Liberal. They didn't really do it from a political point of view. They did it more so from, I guess, what the policies were and what they'd expect to happen if that policy was put into place. And they ran a few different scenarios based on that. So one we want to focus on is scenario 3. And what that's done is modelled between the 2020 and 2022 and the potential outcomes that would have for dwelling prices and for potential rental incomes for different major cities across Australia. So what they've done in that modelling is they've included a 50 basis point rate cut as well, which we'll touch on a little bit later on in some of the information that's since come out since the election, but it sounds like that does sound quite possible, if not almost guaranteed, depending on who you're subscribing to and listening to.
So that's a 0.5% drop in interest rates, which is really good for sentiment and good for our back pockets as investors.
Yeah. So in this scenario, they're saying negative gearing stays, obviously, which is aligned with Liberal, which has come to pass this weekend. And they've also said a stable economy. So
what that means, who knows?
Yeah, who knows what they want there, and we're not going to touch on that, but just take that into account when reading through these figures. But I'm going to quickly run through what they're expecting to see. So within that 20 to 2022, they're seeing 9 to 17% increase in Perth for a dwelling. Brisbane's going to be 7 to 13%. We've got Darwin sitting at 0 to 9%. Melbourne 8 to 14, Sydney 8 to 14, Adelaide 9 to 16, Hobart 11 to 19, Canberra 9 to 14, and the weighted average for that attributes to 8 to 14% across the country.
Which is a hell of a lot better than property prices declining for 7 years in Perth, 5 years in Darwin, 2 years in Sydney, and a year and a half in Melbourne. It's kind of really nice to see SQM sort of painting a positive picture.
Yeah, exactly.
Which I haven't seen for years.
Well, I guess it wasn't that positive at the time. It was painted around what may have happened with this election. And a lot of the focus was more so on the negative. This was just what they were viewing as the potential outcome if things went the other way, which is quite exciting. And even when we look at the rental returns potential on that one, it still looks very positive for moving forward, or the models suggest that we're in for some good rental increases. So I'll run through them as well. And it's Perth 8 to 13%, Brisbane the same, 8 to 13%. Darwin would be negative 9% to positive 2%. Melbourne 4 to 10%. Sydney negative 2 to positive 5%. Adelaide 5 to 9%, Hobart negative 2 to 7%, and Canberra 0 to 6%. Obviously, that's a bit hard to keep track of when I'm rattling them off like that, but we just wanted to put that information out there so you guys can see that in this scenario that's come to pass, things do look very positive now, and it's really interesting that sentiment was so bad leading up to what a potential for where this decision was going to go. Like, say we did vote for Labor, it could have went down a certain path, and yeah, things could have turned out differently. But now that we're on this Liberal track, like our expectations, I wouldn't say our expectations, but the information that's being put up there leading to the market is you'd have to expect sentiment's going to change quite drastically.
Yeah, I think we'll talk about that in a bit more detail towards the end of this podcast, but I certainly slept better on Saturday night, and I think a lot of Australians probably did, because sometimes business as usual in a market where we are in the mid-cycle slowdown, according to Phil Anderson and Fred Harrison, which is a touchy couple of years generally globally. We are technically in a recession in Australia when you look at some of the versions of the numbers that I've seen, and then I've seen some other numbers that make it look like we're actually in really positive growth. There's a lot of numbers being removed off the bottom line with GDP. It's kind of one of those times. So like what I wanted to slide in from there with SQM, and SQM's kind of like CoreLogic, like they're the second biggest analytics company in Australia. They don't always get it right. In fact, I assume they're going to get it mostly wrong with all of those predictions there, but it's nice that someone like that is prepared to put something in writing.
Exactly.
They have something to lose, because if they're not credible, then how do they continue to move reports and things like that they do? And
like in the fine print, like they acknowledge that this is a model, like it's they don't have a crystal ball either. They're just looking at the data and trying to make an informed decision with that data, which is obviously what we're all trying to do.
So what I wanted to talk about now, there's a bloke in Brisbane called Simon Presley. He runs another buyer's agency business, but I think he's also a very good analyst.
I agree.
He puts out really interesting reports and also blog articles. For any of you that are sort of data orientated like me, I actually think medium term he'll become an analyst. I think he's a great analyst, and I think that's where his passion is, clearly based on the data that he produces. But he sort of put something out which was the Property Market Outlook Boom Conditions was the title of the article. That was earlier this year in January, and some of the positive things, because it's important to remember that while the Current Affair and the Today Show are hammering the shit out of property right now because it's still moving advertising space, there's other things going on behind the scenes that aren't so bad. So he lists off a few of them. Again, I'm trying to not make this dry, but it's information. Australia's created an additional 300,000 jobs. 300,000 jobs in the last couple of years, which is huge. And of those, an extra 200,000 jobs in regional Australia. So that's positive. I was looking at some of the commodity prices yesterday just because I like to look at that stuff as well. And prices of iron ore has gone up by literally like 25% in the last 3 months. Like, some of Australia's commodities that we're exporting overseas are going off their head right now. And you look at some of the mining companies, like I think Rio's share price has gone up 13% in 3 months. Like, BHP's gone off its head. That's kind of exciting because the government captures revenue from that in terms of taxes on the profits, and when the prices of those commodities, also commodity prices on some of the farming stuff that we send overseas, like fruit and veggies and shit, are moving like really well right now. It means that the government captures this net of extra surplus based on other stuff going on that, it's just kind of interesting.
Yeah, definitely interesting. Like the whole idea of, just paying attention to what different, like you said, commodities end up moving in the way that they'll increase in price, and then what that means for Australia's budget moving forward is it makes a huge difference. Like, we're not going to talk about it, it's not something we're experts on, but if you are interested in those things, have a look at the effects that commodity increase in prices will do to surplus and the GDP for Australia.
And the gin and tonic, GDP. So unemployment rates have been pretty consistent, or they've been falling. I think they were up slightly. I think they moved from 5 to 5.2% this month, but still very, very, very low. Like, when unemployment rates are at 8, 10, 15%, then we're normally in a full-blown recession. When they're at 5 point, there's pretty good employment. Asterisks, like the Australian government would have been fully cooking those unemployment figures to get through the election in a positive way. So just I wouldn't put too much faith in that one, but either way, like, it's at least in the right direction, right? And so it's good to see that it's not blowing out on the other side, or we're not seeing that there's that major indicator that's suggesting that there is a recession just around the corner. The federal budget has fallen into surplus now, which is epic. Housing supply is quite tight again in some markets. Obviously, Sydney's a bit oversupplied from a unit perspective. So's Darwin, so's parts of Perth and Canberra, but other markets in Australia are actually quite tight. Like, my property manager of my properties in Brisbane said it's the tightest rental market that she's seen in 10 years of being a manager, and we're starting to see yields already start to climb here, which is cool.
Wow.
Vacancy rates are super low. Australia's population growth is expected to grow by another 350,000 people this year. It's a cool thing about Australia. Like, it's like stuff's not going well, let's just bring in more people.
Yeah.
And you look at the plan between now and the next 50 years, and it's the Australian government's 2050 vision or 2060 vision. 60 million people is the plan.
Yeah.
So we're not even like 35% of the way through that population growth yet. It is insane amounts of growth, and that's what made the UK, then America, very profitable for a long time for a lot of people. Yeah,
it's just, think about, with that thought, how much the government tries to push us towards being a very multicultural society, which I'm really excited about and I love as well, but it also gives them the opportunity to continue to allow people to come into Australia in situations that, say, if our just our natural growth through birth, population growth isn't quite there, there's always that opportunity to keep things moving and ticking along, which not every country has, the resources and land available to do that, which Australia does. Yeah, and my grandma's Dutch, my wife's great-grandpa's like Greek, I think, or so they say. They don't look it at all, but so they say. You know what I mean? Like, Australia is a beautiful place with so many different things going on, and I think it adds to the diversity, as well as, the population growth is just good. Yeah. People need somewhere to live, and I want to create houses for them. Exactly. Tourism is going really well. Brisbane, Gold Coast, Sunshine Coast airports have all been upgraded or are currently being upgraded. It's going to add bulk money into that marketplace over time. If you also look at mining, it's really starting to pick back up in terms of jobs, mainly the research, discovery, and even the operational side starting to pick back up. So when these companies start making more money, they can reinvest back into growing again. Because these companies don't want to make just profit, they want to grow that profit. Yeah, and it's pretty simple. It's like, as you see commodity prices increase, it's like all of a sudden the cost or the return on investment of harvesting that materials might start to make sense more, just because of higher commodity prices, which then leads to more jobs to harvest that material, and it flows through the rest of the economy. He's also said that the federal government has a 10-year plan to spend $290 billion on defence manufacturing, which is jobs. There's so many jobs. Like, $290 billion on defence. I'm just sitting there thinking about that budget surplus we talked about earlier.
It's gone. You know, the RBA, which we'll talk about more in a moment, Simon was sort of suggesting that by mid-year they'll be sort of reducing the cash rate. He was saying by mid-2020, but it looks like it's going to happen now and again later on in the year. So from Simon's perspective, there's some cool stuff going on. And what I wanted to finish with is just some of Simon's forecasts. So because you sort of walked through the SQM ones, maybe you want to do this, Simon, as well?
Yeah, no problem. So the way he's done some modelling as well, not focused on policies from a political landscape, but more so on lending policy by APRA.
Can I just touch on that quickly? The main reason property prices have declined in Sydney and Melbourne, and they had to, and they still have to, in my opinion, they'll continue to decline this year. But the major reason this happened was because they made it just really hard for you and me to borrow money.
Yeah.
And so it is really, really, really stringent lending. And, you know, that's really what induced this.
I don't want to say that's exactly it, but it's definitely played a major part in it. Whether like the market was overcooked or not, this was definitely the trigger to set it off.
Yeah, like a 20 to 25% top to bottom decline in Sydney and a 15 to 20% in Melbourne is beautiful. Unless you bought in 2017, which means it's really not nice right now.
Yeah.
But it is a beautiful thing for a bit of a reset. And I went to a Michael Matusik masterclass last year and he said, you know, this is what was going to happen. And he said by mid-2020 it would be starting to make more sense again, and it would have kind of wiped out or created a bit of a clean slate, because you've got to remember that Sydney and Melbourne were very inflated, but Brisbane hasn't grown for 11 years. Perth has declined by 25-30% from top to bottom now. Darwin has declined by 35%, expecting to drop by 40% top to bottom. You know, Hobart's run off its little head somehow.
Yeah, it'll probably go up 1,000% in the next 2 years, who knows?
It's just like, you know, as long as the speculation continues, it'll keep going up and then it will come back as well.
Yeah.
But, you know, once Sydney and Melbourne recorrect, there's not really an Australian affordability problem. There's a Sydney and Melbourne problem, and it is well and truly on its way to sorting itself out.
Yeah, exactly. And like it all had to come into play. And it's also, if we're now looking at interest rates dropping, if I wonder about this, and I thought about it a few years ago, it's if they knew that this was something that was eventually going to happen, or that's the way that we're tracking towards an interest rate drop, they had no other option but to make lending harder first. So then when the interest rates drop, it's not like, oh, now all of a sudden you can borrow even more money with the interest rate drop, go out and spend even more money on those properties in Sydney, make the market even more unaffordable, and create a larger problem or a larger divide that had to correct either way.
I love that. Like, I've been following Phil Anderson's updates via email for 3 years now, and he's been sending through these little snapshots on what the rest of the world is saying about property in Australia. And for years and years and years, it was Sydney and Melbourne bubbles. When are they going to pop? And then it turned to Sydney and Melbourne Australian property prices are correcting, and you know, 40% declines and all that stuff. And now it's Australian government best practice in manipulating manipulating the monetary system to force property prices down. Sweden is following suit. Canada's following suit. It's been in the New York Times. Like, you know, this is like the Financial Review is reporting on this shit. Bloomberg's reporting on it. Like, Australia is now best practice for artificially tweaking the system to take the pressure off prices by just making it really hard for anyone to borrow money.
Yeah, there's a reason why Australian property is one of the best performing assets in history, and we're obviously doing something right up higher or up on that higher level. Who knows exactly what it is.
Australians just tolerate their government constantly tweaking their monetary system more than other countries, I think.
Yeah, I think we allow them to keep playing the game, which they are looking after us in the long run. It's just, like you said, if you buy at certain times, there is some pain that's attached to it, and it's, I guess, just being aware of where we are in the cycle.
So there's 3 scenarios here from Simon based on the 2019 forecasts. Let's just talk Brisbane, Sydney, Melbourne, because let's face it, that's 75% of the market medium term.
Cool. So I'll focus on Sydney first, and I'm going to run through scenario 1, 2, and 3. So scenario 1 is no changes by APRA. It's just continuous business as usual. For Sydney, in that scenario, they're saying a 7 to 10% drop, or that's what they're predicting
this year.
With scenario 2, they're looking at a return to what they would call sensible credit policy within the first quarter of this year. So
which didn't happen.
Didn't happen. We're already past that. In that scenario for Sydney, they were saying it would be a -3% to -6%. So it's gotten a little bit better in that scenario. The third scenario is the second quarter. So where we're in right now, if we see a return to sensible policy sometime before June 30th, then they're predicting that Sydney will see a drop of between 6 to 9%.
Yeah, so Ads and I have been producing content for years, and I've been saying top to bottom decline of 20-25%. Like, if you follow the right analysts, it's been pretty clear that was going to happen.
Yeah.
All year we've been saying about a 7 to 10% drop in Sydney, Melbourne. I still believe that that's going to occur, and I think it's responsible if it does.
Yeah.
Like, I would hate prices to start correcting too early, just because I don't think the bleed's been enough yet to properly reset that market and build long-term confidence.
And it tends to, from what you'd see on how markets move, that if it does start to recover quickly, it tends to not like break through or sit relatively steady for a long amount of time moving forward, rather than go, oh, we're recovering again now, this drop isn't happening, fantastic. It rarely just jumps and runs away. But don't hold that for a grain of salt. Do not listen to that as advice. It's just purely an observation that I've made personally. But if I look at then Melbourne, in the same way, so we're going to go scenario 1, which is no change, scenario 2, which would have been a change in the first quarter, or scenario 3, a change right now. Melbourne's predicting a drop in 5 to 8% for no change, 0 to 3% drop if they did it in the first quarter, or otherwise 4 to 7% drop if they did it this quarter. So yeah, we're basically looking at somewhere between...
Declines.
Yeah, it's declining.
You know what I mean? The market's still declining.
So then if we compare that to Brisbane, so in scenario 1, we're looking at no change, 0 to 3% growth they're expecting. So still, it's a positive growth. We're sitting relatively flat, which is better than a decline. Scenario 2, which is first quarter, would be a 3 to 6% growth they'd predicted. So that would be quite strong. I know I'd be very happy if we saw 5% growth.
I'd be happy to just see growth, man.
Yeah.
After the last few years, I'd be stoked to see a little bit of growth.
And then, for the scenario 3, with changing that policy back to a sensible way in this quarter, would sit at 1 to 4% for that one. So
what you've got to remember with this data, right, is it's citywide. Now, Brisbane has done, I think, minus 0.2% in the last 12 months, but some suburbs we've bought have done 1% growth. Other suburbs we've bought have done 11 to 13% growth. So you've got to remember that in all markets, you know, parts of Sydney might drop by 10% this year. Other parts of Sydney might drop by 2%. Other parts might even go up. We're not an Australian market. We're not a Sydney market. We're a series of suburbs, each with completely different demographics, indicators, and some supply and demand scenarios. And, you know, things change. You know, citywide it can look scary, but there's huge opportunities. Like when people say to me that Brisbane is now cheaper to buy in 2019 than it was in 2008, not people, core logic. That makes me excited. And then I go, well, hang on, like the average property that I've bought in Brisbane has gone up by 20% in 3 years for my own portfolio. Like, you can outperform averages if you know what you're looking at.
Yeah, definitely. And I think when you look at the larger the median price point or averages over a larger scale, it's just, I think you can only really use that data correctly if you then take out the time frames or like extend the time frames much longer. So it's like if we're looking at Sydney as a whole, you have to be starting to make predictions or make assumptions based on a really long time frame, because when people try and predict a really short amount of time over overall market, it's just very hard to do, because as Ben touched on, it's who knows how those individual little markets are actually going to move. But as you see the longer time frame, those averages tend to make a bit more sense.
Yeah, so that's what I love about understanding history and our analysis, is that Sydney, Melbourne and Brisbane in the last 46 years, according to Homely and Core Logic, have, you know, all grown by an average of over 9.5% per year. Now that is, you know, in 1988, prices in Sydney over that 18-month period dropped by 25%. You know, in the record books, it'll show between 2017 and 2020, prices in Sydney dropped by 25%. But you know, that's included in the averages over time. Like, as long as you've got a long-term approach to investing like we do, the averages generally work out in your favour, because as soon as people make more money, they either spend it on their home or they spend it on their rent. It always ends back up in the land prices, and you can look at a lot of people from history like Henry George or Ricardo's law of rent to really understand that land equation, and unfortunately most people don't. So Residex was just bought out by CoreLogic. We buy their reports sometimes to help us identify areas with potential for growth, just as one out of about 40 indicators we look at high level. And some of these suburbs in Brisbane, in their report, this is the Brisbane report I bought, are predicted to do 3% over the next 5 years. There's other suburbs that are predicted to do 8% growth per annum over the next 5 years. So again, who knows? But that's just another data source with, you know, more, I'd call that more bullish than bearish predictions. Like, that's pretty extreme.
Yeah, it was quite bullish. Who knows if it's going to turn out to be right or incorrect?
Time will tell.
Exactly.
Like, you know, I'm not banking on it. Let's talk a little bit about APRA's press release on the 21st of May, which is kind of interesting.
Like, I like it because it ties in well with the other two, I guess the SQM Research and what Simon Presley's done over at Propertyology. And they've talked a bit about how things will move forward. One, if Liberal got into government, tick. And then two, with Simon Presley in particular, talked about what would happen if APRA's, regulation or credit policy became a little bit more reasonable. And so now we're seeing this update that's come out from APRA recently, and they've basically, it's not locked in, but they've begun consulting. So reaching out to firms and different stakeholders within the environment and figuring out possible revisions to its guidance of the serviceability assessments that authorise deposit-taking institutions. So to step that back a bit, we've got specialty lenders that fall outside an authorised deposit-taking institution. They're not a bank, they don't take your money. They just offer loans, and they're a specialty lender. They do not have to follow this guideline put in place by APRA.
But they kind of do, in a soft way, sort of, just because if they collapse and they weren't prudent, then they get hammered. You know what I mean?
It tends to be priced for them to, you know, take into account the extra risk that they've got to wear and everything else involved. So
what ADS means there is, like, you could go get a 4% interest rate with CBA right now, but you might get a 6% rate with one of these like tier 3, tier 4 guys.
Exactly. So if we talk about these authorised deposit taking institutions, they basically, they do the majority of the loans to a lot of lenders out, to a lot of borrowers out there, and they're saying APRA's put it out there that they're going to go in, they're going to review, they're going to start talking to people about revising what they're doing to assess. So
the thing that made assessment rates like that really difficult is that they said that they're assessing you at a 7% interest rate on all of your loans. So let's say your rate's 4%, but they're assessing you at 7%, and then they're assessing you at principal and interest on 7%. That is the way that they made it really difficult for people to borrow money, because it's like, well, I'm earning 100 grand a year combined in my household. I've got this one investment property that's not actually costing me anything, but according to the banks, it's super, super negative on paper. I couldn't go borrow money. So what they're doing is reassessing if that 7% is a meaningful benchmark anymore.
Yeah.
Which is effectively, instead of rolling back all the stuff that they just changed with the Royal Banking Commission, APRA is just stepping in and tweaking that one little thing. And then the Reserve Bank of Australia, as we'll talk about in a moment, is going to drop rates, which all of a sudden means, hey, we did the right thing by cleaning up the sector and pushing prices down. Now we don't want them to go down too far. Let's just start tweaking the high level numbers again and effectively drop our pants longer term and make it really, really easy for people to borrow money again. That's what's happening. That's money comes in, contracts, money gets really easy and slutty and expands. And that's the cycle.
This is something we used to talk about a bit when I was in the finance space, and I don't know, it was always quite an interesting topic for me, and you used to bring it to my attention that it was, look, it's going to get easier again, like things were tracking in a certain way and they had been for quite a long time.
Because I've seen this happen 3 times in 10 years, you know, personally, like it just this is the way the world works. And you look at history and this is how it's always worked.
Yeah. It's just part of what we're talking about with those overall cycles of how things ebb and flow, and unfortunately it was just something that had to happen to help I guess, govern what was happening down with the Sydney prices. But what's exciting about this is it gives what they're suggesting is giving the institution the ability to decide for itself. So what that means is, to me, like it kind of blows my mind. Like they're talking about taking away mortgage brokers, but now they're essentially saying every individual bank has potential to maybe have different assessment rates and different assessment conditions. So you might walk into a Suncorp bank and they'll say you can borrow 300,000. You might walk into Westpac and they'll say you can borrow 500,000.
Which is exactly how it was 3 years ago, and for most of history outside of the really contracting phases. Like in the past, when I was earning 60 grand a year, walked into Bank of Queensland and could borrow 700k. Walked into CBA and they told me I couldn't borrow 300. Like, this is how it should... Like, that's an open market, right? Like, hey, we've got too many investors. Our books aren't looking to take on any more risk. We're just going to not lend you money. Or, hey, our books look really healthy. We've got an appetite for a bit more risk at the moment. Here you go. Here's some more money. And that's how it should work in an open market. But there's a lot of tweaking from a government level at the moment with the banks.
Yeah, well, like that's their place. Like they're in place to regulate. So they're not doing a bad thing. Like they regulate to try and keep the overall economy and the lending space less risky for everyone involved. So it's just like they do their part, which is regulations. The banks do their part, which is pushing up against those regulations and seeing exactly how far they can push the envelope with what they can and can't do. So what I love about this is it gives them a bit more freedom to kind of make those decisions for themselves and to assess what they're actually doing internally, rather than just saying, oh no, we're worried about the overall market, so who cares what you're prepared to do as a bank, or we've already made that decision for you.
And I'm so grateful Australia has that. Like, yes, the last couple of years and maybe the rest of the year will hurt some people, and it sucks that there's people on the other end of, when you look at Sydney dropping in value by 10% or 25% top to bottom, you've got to remember that that's people's income, that's people's equity, that's people's retirement plans, that's people's goals and visions if they're speculating in property gone. That hurts individual people, but these things are here to protect us from ourselves. And it was only 2-3 years ago that Commonwealth Bank was boasting globally that it was the most profitable bank in the world. Like how a bank in Australia is the most profitable bank in the world. Like Warren Buffett's banks were doing half the level of profit that Commonwealth Bank was, run by like who? You know what I mean? It's like there's a serious problem there. So I'm glad that this has happened.
Yeah, the four majors do have a little bit of a monopoly. It's a strange way to say because there's four, but they do have a lot of control in the market, and I think that allows them a lot of freedom.
So let's talk about the banks now, just really briefly. From an inside perspective, our mortgage broker's been saying to us for quite a while that things actually, as of November last year, started to get a lot easier. Even before all of these things started to come through, you get ANZ coming out in the media 3 weeks ago saying that they are Australia's investors bank and that they want the investor lending, and the other guys are starting to follow suit. You get the Liberal Party committing to providing deposits for the first 10,000 first home buyers that come and ask them for it after the election. Like, there's lots of things going on here. Did you hear about this?
No, I didn't hear that one.
And then Labor said they'd do the same thing.
No, that's them. Isn't that them securing they're saying that they'll cover the mortgage insurance to cover the difference in the deposit, so you only need a 5%? Yeah,
they're saying you do 5% deposit and then you'll get the rest from them. Isn't that what's going on?
No, you don't get the rest from them. But say at the moment, if you put in a 5% deposit, you'll have a mortgage insurer come in and insure the difference between the 5% and the 20% that you get charged up front.
So they're paying the insurance, they're not paying the 15%?
No, they're just paying the insurance. So it's like you don't have to get stuck with that extra $10,000 to $15,000 cost as a new home buyer coming in.
Which is pretty exciting if you can be putting down a 5% deposit again with no LMI and you get free stamp duty as a first home buyer too.
It makes a huge difference in the lending equation. Like throwing a first homeowner's grant, the first homeowner stamp duty concession, and now we're going to have a government-backed mortgage insurer that doesn't cost you anything. Like that makes it a pretty easy step in the door for a first home buyer. So I don't know if people are still complaining out there about it, but I wouldn't be.
I remember when I bought in 2017, I put down a 2.5% deposit, no LMI, no stamp duty. So, you know, it's sort of getting back to the good old days, or the irresponsible as fuck days.
Yeah, just doing it a bit more responsible way, and I guess the government's put their hand up to help out young people a little bit more with that. And some of those things I just said is obviously state dependent as well, so don't just go with that as definite.
Yeah,
check your state to what concessions you do get and what grants are available.
What happens historically when we get a surge of first home buyers coming into the market is people that owned those first homes have made a bit of equity, they cash out of them and they upgrade. Those upgraders make a little bit of money because there's more pressure from the second home buyers, and then they move a bit closer to the city or a bit closer to the beach. It's kind of the government's way of, again, artificially stimulating the economy from the bottom up, as opposed to what they've had to do in the last 3 years, which is a top-down correction. So let's talk quickly about the Reserve Bank of Australia. I think there was another press release in the last few days. The Reserve Bank Governor has given the strongest indication yet that interest rates will be cut in June. The cool thing about working with so many amazing people and investors is they all do different stuff. Like, we've got heaps of clients in mining, right? So we know what's going on mining a year before it happens. Like, kind of, like they tell us how many jobs are being created or what the new mines are that are opening up. Like, same with working with people in corporate banking and finance. You know, like, we're relational people and we ask a lot of questions. And one of our clients, Jeff, basically buys money from around the world and then sells it back to the banks. And in all of their forecasting and in future mapping for their market, they are already forecasting a 0.5% rate drop within the next 9 months from today for that to come through. Now, these are smart people that know people in government. And you know, that's kind of interesting that all of their future business models are based around that happening. And, you know, they say there's no insider information, but I can guarantee at the highest level there's lots of conversations happening well up front.
Yeah, and it's more so as well, like, it's if everyone's talking about these things, it's either it's come from like someone who's done a really good job at creating that story and getting it out there, or it's because people have started to notice a trend or something happening or a consistency of information between different people that may start to line up and they make decisions on that. Like, it's all a little bit airy-fairy.
Yeah,
like,
it's all a bit conspiracy.
But it's so exciting being able to talk to those people on the ground and just, you know, getting those insights for what they're feeling, how their job's going, are they feeling confident in their own job and in investing in the future, and just really getting, like, I guess, a touch point with all those different people in different industries.
For sure. So, you know, whether it's SQM, Simon, Residex, APRA, the banks, the Reserve Bank, you know, our thoughts are it's a better conversation than we've been hearing for 3 years.
Exactly.
And that slowly, not for the average person that's still consuming all their media through whoever, but for you guys and for us, it's really interesting to sort of go, hey, there's just like a little glimmer of hope down the line. And it's still going to be a rough year for people in Sydney and Melbourne. Certainly not the right time to be entering those marketplaces right now. But maybe down the line, according to SQM or Simon, things might look a bit more positive. And, you know, that's exciting for me as an investor who isn't looking for short-term gains, but has a 15-year approach and generally does want to see people do well over 15 years.
Yeah, and for me, I just sit here and I just think, like, we've touched on a few different articles that people have written and some information that's been put out by some reputable companies, and it's pointing towards, okay, if we see these set of, I guess, conditions happen, we should see an improving in market conditions and improvement in sentiment. And it's almost like those things have happened now. And so for me, it's just exciting. It's like I see a great buying opportunity. It's like, do we sit on the sidelines until we wait for that sentiment to be there? Or do we see that it's like, okay, we've seen a lot of these indicators come around to where they need to be now. Is now the time to buy, or are we potentially missing out?
You know, the thing that Ads and I don't have, because I completely agree with you, man, and we'll talk about our thoughts and our strategies personally in a moment, which has nothing to do with your personal financial situation in any way. But, you know, the doom and gloom on the horizon, I think a fair chunk of it's already been priced into Australian property prices now. Like Brisbane being cheaper than it was 11 years ago, Perth being 20 to 25% cheaper, Darwin, Sydney and Melbourne being 20% cheaper by the end of this year. That's exciting stuff as an investor who was looking for a reset to bring confidence back into the medium-term market, because I don't care what happens year to year. I don't even look at my capital gains year to year anymore, unless I need equity to be able to move forward again.
Yeah.
You know, the horizon says that we're in this mid-cycle slowdown point at the moment where historically America has come into a recession period over this period of time. You've still got that China thing going on there where they've been cooking their books for a while, for 30 years or something. You know, maybe not. It's another conspiracy theory. But, you know, Australia has had 2, you know, quarters of basically negative growth that were probably maybe slightly tweaked to just keep us out of a technical recession. Like, there's things that can happen during this period, like stock markets historically have got hammered in the next couple of years based on history. Generally, prices sit flat or continue to decline in that mid-cycle phase. So it's certainly not a, hey, everything's rosy, go and jump into it carefree like you could have in 2011 and everyone's going to make money. Smart investors are doing smart things. Silly people are still doing silly shit. And I think if you're not educated with the right strategy or the right support, it's still a couple of years where you can, you know, do yourself more harm than good. I don't want to be negative. Like, I just also don't want people to be reckless. Yeah,
it's you're right. And like it obviously, like we touched on before, there's markets within markets and there's things like that. So it's not like we're saying, yeah, it's a buying opportunity, go out there and grab anything you can before it runs away. It's not the case at all. It's more so there's just, it's nice to see that switch is turning a little bit and that it's starting to head in a different direction, and just seeing how fast it moved in a negative direction, it always, I don't know, I'm really excited to see what the future brings.
Like, my personal thoughts is within 18 months sentiment will be a lot more positive, and within a couple of years time things will be potentially better. But then you've got people saying, like Harry Dent, that 2 to 3 years from now it could be the worst condition in Australia in a century. So take it all with a grain of salt. Like, my personal investment philosophy is I just invest for the long term. I invest in terms of like my Holy Grail, which I just did a video on YouTube. You can check it out, the Holy Grail of investing, on our Pumped on Property YouTube channel. You know, I look for properties that get long-term capital growth, great cash flow. I try and time the market to the best of my ability and buy the bottom. If I'm selling, sell it as close to the top as I can. But, you know, history shows me that just being in the market for the long term is a much better strategy than trying to get in and out of it.
Yeah, it's like they've shown regular investing, like, or on a regular time frame, is much more successful than trying to get in and out of the market consistently with cycle trends.
Yeah, you know, like property moves a little bit slower than stock markets, and I feel like I understand it to the point where, you know, I might not pick the year or years, but we can sort of understand it based on Heron Todd White's reports, Core Logic stuff, Phil Anderson, Fred Harrison stuff. But those guys, SQMs, they're all right until they're wrong, you know what I mean? And it'll be 50-50 for all of them over the long term. But, you know, timing, you know, Heron Todd White was saying that Sydney was at the top of the market in 2016. You know what I mean? Like, it said it was going into the declining phase in early 2017. Like, there's people that are saying these things well before they're happening. Like, you know, Brisbane come off the bottom and then moved to start of recovery, got a little bit of a rising market, now it's back to start of recovery. It's kind of like you can use that information from people like Matusik and SQM to make slightly better decisions. You know, when Brisbane, for example, for me, which is the market I'm focusing on for my properties, hasn't grown in value when you factor in inflation in 11 years, but over 50 years has done equally or better than Sydney and Melbourne. You know, I, as a long-term investor, go, well, that's kind of an interesting time. And then you overlay an election year, shitty sentiment, really hard environment to access money. That aligns to my philosophy, which is around timing things better.
Yep.
And then I like to buy stuff, you know, below market value, and, if I can, which is very difficult most of the time. And then, you know, add value to what I buy as well, like through a granny flat or through a little reno, or maybe from buying land and building. Like, it's not rocket science, but it has taken us both 10 years to sort of figure out what works for us. And in 10 years, I'm sure it'll be different again, you know, as we learn more.
Yeah, like I think that's a key point. Like, it's always about learning and growth, and you see all too many times that once someone's realised that they've figured it all out, it's when things start to decline and go the other way. So yeah, it's just being open to what the world throws at us and kind of just running along with it. So it's why, like, I love the strategy that we employ and how it is focused. Like, we take into account the timing, but we try and make sure everything else is nailed down right as well. So, like, moving forward, it's you're not worried about I guess the smaller things that could potentially get you unstuck, and the things that you may quite easily overlook and not think as a major concern.
The biggest risk, I think, you know, out of everything that I understand within property, is me not being able to make repayments on a property and selling it at a time when I shouldn't be selling it. Like, in terms of all the risk in the world of investing, because as someone who can hopefully hold my properties for the next 15, 30, 50 years, as long as I can hold them through the good and the bad markets, I know I'll end up better off, and my kids will end up better off, and I will have a passive income stream in the future for life. The biggest risk is that you go into something thinking it's all going to be rosy. Interest rates change, you lose a job, you don't have a savings buffer, or the market corrects and you're forced to sell at that time. Or you've overpaid at the wrong time just before it declines, i.e. Sydney or Melbourne in 2017. Now your property that you were going to sell short term, which wasn't what you really wanted, is worth 20% less, and you've got to wait, you know, depending on whose data, 3 years to 10 years to actually get that money back.
Yep.
And so, like, what scares me is having money not working for me in this stage of my life when it needs to be working for 30 and 40-year-olds if you want to be financially free by late 40 or early 50s.
Yep.
You don't want to get caught out with dead money for 10 years in your prime earning years, because that really stuffs up your ability to create things before you're 60.
Yeah, it just delays, right? Like, and there's no other way around it really, unless you then start thinking, oh, yep, let's start looking at short-term cash plays to try and make money really quickly. And yeah, you've heard it all too many times with obviously all the calls that you do talking to everyone out there, and the story is it goes so similarly, which is yeah, you have this idea, you start to see it through, and then you kind of realize that, oh, I didn't account for this, or I didn't account for that, and in a small time frame there is no room for error like that. It's you're going up against people that have done this maybe 10, 20 times before. They know what they're doing, they account for these things. So like me and Crystal talk about it all the time. It's like when you see that really cheap property, like that one, and you're just like, oh, I just want it, like it's the best property I've ever seen. You go out and look at it and there's always a reason it's really cheap. Or you look into a deeper level into the data and there's an easement through it. It's flooded. There's something going on with that property.
It's always something too good to be true.
Exactly. It's like, there's sometimes situations where, you aim to get below market price and there's conditions that allow that, but you're not going to go out there and buy something that's 30% underpriced and then within a year sell it.
On realestate.com,
I've made hundreds of thousands of dollars. Yeah.
Just if it's that good, it's either been bought pre-market or in the first week of coming to market.
Yeah.
Nothing that sits there for a long time is ever value.
I can't even imagine that would make it to market in those situations, because let's be honest, like, real estate agents are allowed to buy their clients' properties. Like, it's possible to do, and they know people and everything. If someone goes, look, I just want this gone ASAP for a fantastic price, a real estate agent knows someone. Yeah,
like you think about 30 to 50% of what you've been inspecting at the moment's off market. Like, if they're not picking it up, our client is.
Yeah,
and
exactly.
You know, like, one thing I want to finish on, which is kind of outside of this, is, you know, Warren Buffett talks about in his HBO documentary on his life, which is just value investing.
Yeah.
So he used to do this thing, which was just buy the cheapest, sell it as quickly as possible for a little bit more. Benjamin Franklin coined that value investing or he was like more the cigarette bud, like get that little tiny bit of growth and then flick it out.
No,
and then he moved to value investing.
He was more so value investing, but not selling it quickly. It's more so find those opportunities to purchase when, and say like the market or the industries say is undervalued at that point in the cycle, and then find a company that's also undervalued, and then do your calcs on it and just imagine, okay, long term, what's this company actually worth, or it can relate to property in the same way.
Like, what I love about this concept is when I was just getting started, and this is a big difference between like me at 24 and me at 34, and I used to hunt for the cheap property. I thought value was buying below the median price point in the suburb and buying the cheapest property.
Yeah.
What value is, that strategy, I reckon, has cost me 2% per year growth on whatever I could have done in that same suburb with a higher value asset. So now value looks like bigger piece of land, closer to the city or walking distance to the beach, metro markets. Like, there's all of these rules around capital growth and cash flow and timing that we have in our business, and we have to hold ourselves accountable so that our lizard brain doesn't take over and make emotional decisions when we're buying stuff for ourselves or for clients. And value looks so different to what most people think that it does. Sometimes paying market value in the right suburb, in the right street, for the right property at the right time. Think about any quality property purchased in Sydney in 2011 with an understanding of timing overlaid and the market cycle. By 2017 looked amazing. Now, an example of this is in 2011, you could have bought a property in the south side of Sydney for $500,000 a home on a nice big block in a good suburb. And then by 2017, that same quality home was worth $1 million. Or you could have bought the cheaper property at the time for $450K. So you save 50 grand. You thought you were like balling and saving yourself money, but you were just buying a smaller home on a worse piece of land in a worse street in a slightly worse suburb. And now that same property is worth 800 grand. So the decision to go cheap rather than spend that little bit extra on value costs you 50 grand up front, but over a 6-year cycle, caused you 150 grand loss. They're the things that we think about every time I buy anything for myself or a client, as opposed to the short term, like when I used to think I'd made 10 or 20 or 30 or 50 grand, I once made 200 grand on a property on the day I bought it. Now that property has declined in value by $90,000 in a year because it was probably the wrong long-term asset. I was thinking about it short-term as a flip, then I couldn't flip it, so now I've got a negatively geared asset that has dropped by 90 grand, not because it's dropped by 90 grand, just because there's less buyers in that price point that don't want that asset.
Yeah.
So you learn as you go, but value is important. Yeah,
so the key point there is cheap doesn't equal value, which is like a consistent message that we see a lot of people coming through the doors. It's really like it's really hard to distinguish between the two when you don't know what you're looking at really, really detailed. So it's like Ben touched on, you might be looking at a property that's worth, let's call it $380,000, and it could be relatively cheap, and you're like, this is great. Like, it is like on a bit busier road, but I'll take that. It's not too busy. That'll be fine. Not taking into account what happens if the suburb gets busier. Your road gets busier, and all of a sudden you are on a really busy road.
You're on an arterial road with units all around you in 20 years' time.
Exactly. So it's just being conscious about those longer term things, because property is a longer term play, and making those decisions with that in mind, you actually start to realise value versus cheap, and it becomes a little bit more apparent, and the deeper and deeper you dive, you start to see that value more and more easily.
What's Charlie, like, who's Warren Buffett's business partner, say, like, price is what you pay, value is what you get?
Yeah.
And it took me 10 years to really figure that out, but I just go for quality now, and I'd rather own one quality property every 5 years than buy 5 cheaper properties every year for 5 years and end up with a big problem in the future.
Yeah.
One that I didn't understand. So I hope you've enjoyed this podcast. Ads and I have to actually go do some work now, but this has been really fun. I hope you guys feel sort of like we do, which is kind of for the first time in a long time actually excited to be an investor again. I believe that there's some potential, particularly over the next 7 years, in parts of Australia, not everywhere. but parts, and you know, your job now is to get educated about them.
I'm just looking forward to not talking to my bank every week about.
Yes, you can borrow money. What?
Pardon?
You can borrow money?
That much? Oh, sweet. So, well, I guess we're done.
So that 6-year period of my life where I haven't been able to borrow money is now closed, and I can borrow stuff again.
Yeah.
Awesome. But yeah, like this is the joys, guys. Like, I suppose it's a cycle for a reason. Things go up and down, and there'll be plenty of ups and plenty of downs over all of our lifetimes. So please make sure you protect yourself with a good strategy, a good plan, and more importantly, like a good team of people around you that can help you do, you know, better than average.